Good afternoon and welcome to the October 9th edition of Office Hours presented by the Maryland Center for Collegiate Financial Wellness. My name is Dr. Tisa Silver Kennedy, and I thank you so much for joining me today. As always, I just want to give you a little bit of information about the center and its vision, then a disclaimer, some updates, and finally, we'll get into the questions that have been submitted by members of our community. So let's take a look at the vision. The Maryland Center for Collegiate Financial Wellness was founded in 2021 with an ambitious vision for students across the state of Maryland, and that is for all college and career school students to be able to achieve these 6 pillars of collegiate financial wellness. Those are being creditworthy, ready, resilient, empowered, successful, and thriving. If that sounds like a mission and a vision you'd like to learn more about, please do visit us online at mccfw.org to find ways that you can stay engaged and support if you feel so inclined. As for office hours, we do this roughly every 2 weeks to give you updates about what's happening in the world of student loans. But as much as we try to be accurate, a lot of things are happening. There are a lot of moving parts here. So I have to issue a quick disclaimer that office hours is presented for informational purposes only. The information that you receive today does not constitute personal, legal, or financial advice. There are many factors that you should consider when you are thinking about your personal student loan repayment strategy. The strategy is different for every person, just like financial aid packages. It's different for every person. So you want to make sure that you're taking in the broader information like that which we provide, as well as information from the lenders, the servicers, and your personal situation before you make a decision about how to proceed. All right, now I want to give you all some updates. A lot has happened in the 2 weeks since we last got together, and I just want to say you all are going to have to pardon me a little bit. My voice is a little bit weak, so I'm going to try to mince words if possible, but still stay accurate. We received a lot of communications from the Department of Education, new PSLF payment count letters, some updates around income-driven repayment, the end of Fresh Start, and the fate of SAVE. So I'm going to just start with Fresh Start, PSLF, SAVE, and then we'll go to the ed communications around PSLF. So Fresh Start was an initiative started by the Biden-Harris administration, which basically made it easier than ever for student loan borrowers who are in default to get those loans out of default and on track to benefit from IDR plans and forgiveness options such as PSLF. Fresh Start was set to expire on September the 30th. And shortly before that, we heard that it would be extended, but only for a couple of days. So Fresh Start, as far as I know right now, is no longer available. And it stopped, I believe, October the 2nd. Can't remember if it's October the 2nd or the 3rd, but it was a very quick extension, I believe, for maybe 2 days. So the Fresh Start opportunity is no longer available. And if you have student loans that are in default, you need to go to studentaid.gov and take a look at the more traditional options to bring those loans out of default and back into good standing. Next, when it comes to PSLF payment counts, many of us have been waiting and waiting and waiting, but there was a pause that began in May and ended in mid-July around the processing of PSLF applications. And many of us received updates at the very start of October. So if you have not checked your payment count in a while, I encourage you to please go to studentaid.gov, log in, and then once you get to the main page of the dashboard, click track your PSLF progress so that you can see if any updates have been made. Also, when you log in on the dashboard, underneath the banner where your aid is, you should see a PSLF update with an attachment there if you did receive an update in correspondence from the Department of Education. Next is SAVE. SAVE is still tied up in the courts. We don't have any indication of when that battle will be resolved finally. However, the Department of Education has restored access to the online applications for both income-driven repayment plans and direct loan consolidation. So if you were trying to accomplish either of those feats, applying for IDR or consolidation, you can now complete those applications online at studentaid.gov. I have noticed one thing with the IDR application, though. There was not an option, at least from my view, there was not an option to select the financial information transfer. So After I got through most of the application, it asked me to upload documentation. Prior to this shutdown, you were able to give the Department of Education permission to pull your information straight from the IRS. And that, of course, made the IDR application process much more streamlined, and you could see results much faster. I did not see that option within the application yesterday, and we'll definitely be asking around to see if that's universal or if that's just unique to me and a couple of other borrowers who have observed the same thing. And lastly, let's go back to Ed Communications. I mentioned the PSLF update. I just wanted to show you all an example of what the new PSLF qualifying payment count letter looks like. So in this new letter, you'll see that there's still a chart there. The chart looks different from what we saw when Mohila was sending the correspondences out for PSLF. So here you have a list of loans. In this case, there are 3 loans listed. One of the loans has no balance, so you'll notice that that loan has no payment counts. That's because PSLF is not valid for debts that have already been repaid. The final 2 loans there, you can see that there's a balance, and you can see there are 4 columns. There are PSLF eligible payments, PSLF qualifying payments, and then the same thing for TEPSLF. And in this case, the borrower has 72 eligible payments. That means that's the max number of months that they could get right now qualifying toward PSLF if they have certified employment to match it. But the number of qualifying payments shows the number of months where they actually have employment certified. So this is the new PSLF payment count update, and you may have received one of these letters. Just make sure you go to studentaid.gov so you can take a look and see if your account has been updated either by the Track Your Progress link or by taking a look at this letter with the official chart. So long story short, go to studentaid.gov because a lot has happened in the last 2 weeks, and you may have some updates that you are not aware of if you haven't logged in quite a bit. All right, let's take a look at our first official question from office hours. It's, I completed a spousal consolidation a year ago and have pursued PSLF for my wife and me. I received communication from Ed this week, and I'm unsure what it means. Are there any updates on what we can do for spousal deconsolidation? All right, warning in advance. This is a really long answer. You're going to see a whole lot of text, more so than we usually share, but spousal consolidation loans are kind of complicated, and we just want to give you a bit of background before getting to the answer. All right, let's take a look at the first part of the background. So to be clear, in March of 2024, this borrower applied for a consolidation. This was not a spousal consolidation. This was just a consolidation of their existing loans, and they also applied for PSLF. Their consolidation application was denied due to the fact that they had a joint consolidation loan on file. Some of you are probably wondering, what in the world is a joint consolidation loan? Well, back in the 90s, it was okay for married borrowers to take their individual student loans and combine them into a joint consolidation loan. Sometimes people will call them joint spousal consolidation loans or just spousal consolidation loans. This is complicated for a number of reasons. Both parties agree to be held jointly liable for the total amount of debt, regardless of who owed what within that debt, and regardless of any changes to their marital status. So you can see how this would present a complex issue in the case of divorce, separation, or other things. The terms of those spousal consolidation loans specified that if one borrower could not pay or refused to pay the loan, then the other co-borrower could be held responsible for the entire debt. And these joint consolidation loans could be from the direct loan program or the FELP program. A bit more background. So I mentioned that this practice began in the 1990s, and it's no longer available. Give me one moment. There we go. All right, so it's no longer available. In 2006, joint consolidation loans were discontinued. And even though they were discontinued, that didn't provide any relief to people who already had those types of loans, because those loans could not be taken apart, or reconsolidated. So as a result, borrowers with those types of loans could not apply for more affordable income-driven repayment plans. They could not gain approval for PSLF, and they could also not use consolidation as a means to get those loans out of default. There was a lot of advocacy going on behind the scenes, and finally in 2022, we saw some action take place with the Joint Consolidation Loan Separation Act. This would allow borrowers who have either FFELP or direct joint spousal consolidation loans to separate those joint debts into new individual direct consolidation loans, getting them on track for benefits like IDR and PSLF. Now, when the law was enacted, there was not a process that came along with it. So people have been waiting for the last 2+ years for the Department of Education to give specifics about how this process of unwinding these joint spousal consolidation loans would work. And we got an update along with all the other things that were happening at the end of September and early October. We got an update on this. The Department of Education issued additional guidance with their plans to implement the act in 2 phases. The first phase is for the borrowers to request separation, and that phase began on September 30th. There's an application out there called Combined Application to Separate a Joint Consolidation Loan and a Direct Consolidation Loan Promissory Note. It's available to all direct loan and FFELP borrowers, but it's also only on paper. So if you're looking for an online version, you will not find one. And once this request is submitted, it's supposed to be processed and validated within 10 business days by the originator of the consolidation loan. All right, let's move on. In the second phase, this is where the actual separation is supposed to take place. After phase 1 is complete, the consolidation loan originator is going to separate the borrower's joint consolidation loan and then consolidate them, but this time into individual consolidation loans. Ideally, each borrower must complete the note, but in some circumstances, the Department of Ed will allow for just one borrower to complete it without the other. The guidance also said that FFELP borrowers will be in forbearance until phase 2, but for more information, you definitely want to check out the FSA Knowledge Center, and the electronic announcement ID number is there. Like I said at the start, these loans are extremely complicated, and it's good to now have the outline of the process to separate those loans so that borrowers who hold these can get on track to benefit from programs like IDR, and those who work in public service can finally get on track for PSLF. All right, let's move to our next question. All right, Team McPhew helped me with PSLF during a site visit to my elementary school. I received a letter this week, and I'm trying to understand what it means. I've been working in education for over 10 years, and the number on the paper is just 3 in only 1 column. Does this mean I don't qualify for forgiveness? So since this borrower is talking about PSLF, I'm pretty sure the 3 that they're referring to is eligible payments, and their qualifying payments are probably 0. Let's get a little bit of clarifying background before I provide an answer to the question. All right. So in April of this year, the borrower still had FFELP loans. So Team McPhew helped them complete the applications for both consolidation and for PSLF. In late May of this year, their consolidation loan was dispersed, and in September, they received their first qualifying payment count that listed eligible payments of 3 and qualifying payments of 0. As for the answer, to this borrower, you are not alone with that low payment count. This is your first PSLF payment count, and another one should come soon that more accurately reflects the length of your loan history. Eligible payments only reflect months after this new loan was dispersed. So that would be June, July, and August only. Qualifying payments are listed as 0 because even though you are employed, your employment was only verified up until April, which is the signature date on your PSLF application. So right now, the months of May through October haven't been counted for anything because they have not been certified for you by your employer. However, it sounds like you've got a count that should be much larger, and you should soon receive a second count that includes not just the history attached to your newly consolidated loan, but all of the repayment and employment history prior to you consolidating. So hang in there. Know that by getting this first payment count, the process is working as it normally does. So another one should come soon. Just hang in there. You definitely have not lost access to PSLF. You're just at the beginning phases of getting an accurate accounting of your repayment history. All right, let's move on to the next question. It says, hello, I received an update from PSLF with 132 eligible payments and 0 qualifying payments due to missing the employment certification. If employment is certified and qualifying, will all the eligible payments convert to qualified payments and I'll be forgiven? Thank you for your insight. All right, let's get a little bit of background on this borrower before we dig into the answer. So the borrower mentioned that they have been slow rolling the employment certification because they did not think that they had reached 120 months yet. They've worked for the same qualifying employer for 16 years, and they did attend a master's program while they were employed. And so repayment has taken longer, likely due to the fact that any undergraduate loans were put into an in-school deferment during that master's program. All right, let's get to the answer. Before we answer this question, I just have a couple of clarifying questions to ask. One is whether all of the loans are direct, because we want to make sure that that payment count applies to all the loans. The second question is in the same vein. Was there a gap between the undergraduate and graduate programs? And we're just trying to get at, does that 132 eligible payment figure apply to all of the loans? Either way, you should submit your PSLF application to document that employment history. And if your employment is certified for all 132 of those months, then yes, all of the eligible payments will convert to qualifying payments. And once that qualifying payment count exceeds 120, you will be approved for PSLF. If the 132 doesn't apply to all of your loans, after you get your qualifying payment count, you might see different counts for different loans, and then you could consider consolidating those loans so that all of them end up on the same timeline for forgiveness, and that timeline would be based on a weighted average. And that weighted average is dictated by the loan balances and the number of qualifying payments attached to each one. All right, we've got a little bit more for the answer. And you all pardon me while I sip, okay? Just a quick note to remember. With PSLF, 120 payments are not required to complete the application. 120 qualifying payments are required to gain approval for PSLF and have your loans forgiven. However, you should complete your application before then if possible. The Department of Education recommends that you complete your PSLF application once every 12 months, also when you change employment, and after you reach your 120th qualifying month and make your 120th qualifying payment. That final application is the most important one, because if you cannot document 120, then the loans will not be forgiven. All right, let's move on to the next question. I completed my Fresh Start application this summer. I started receiving communications from my new servicer in September. My payments are high. Can I decrease the payment amount? How do I know if my loans qualify for PSLF? All right, let's get a little bit more background, because this is one of those loaded questions. All right, so all of the loans were direct, and they were moved from default during the pause on consolidation and IDR plans. So at the time that this borrower emerged from default, there wasn't an option to apply for IDR nor consolidation. During the Fresh Start process, you're asked questions about basically trying to get to establishing what your payment would be on an income-driven repayment plan. Their loans were placed in the standard plan due to the injunction on SAVE. This borrower has taught in the public school system since graduation. They're married filing jointly, so there could be multiple incomes at play here in that IDR formula. They have not applied for PSLF yet. All right, let's get to the answer. So we highly recommend going to studentaid.gov, because that's where you can find the status of your loans, and that's where you would be able to access all of the applications as well as the loan simulator. So once you get into studentaid.gov, take a look at my activity, or under the banner that shows the amount of aid you have, you can see your recent activity. Take a look and see if you have an IDR application that's listed as in process. And when you take a look at your individual loans, you want to confirm which standard plan you are enrolled in, because there's two standards. One is the 10-year standard plan, and the other is the standard plan for consolidation loans. They're not the same. For consolidation loans, the standard plan could be as long as 30 years. And also, when it comes to PSLF, the 10-year standard plan is a qualifying plan for PSLF. The standard plan for consolidation loans is not a qualifying repayment plan for PSLF. So it's really important to find out which plan you're on. And either way, we definitely want you to complete that PSLF application. The good thing is now that the online application for income-driven repayment is there again. So if you really want to get enrolled in an IDR plan, which is a good idea if you're pursuing PSLF, you want to complete that IDR application to see if the payments on an income-driven plan will be lower than your current payment amount. If you're not able to see the number in there, you can also use the loan simulator at studentaid.gov, where you'll answer some questions and they'll give you estimates of what your payment would be under every income-driven repayment plan that you are eligible for. Just a reminder here, we're coming off of a period of some very relaxed rules where during that time it didn't matter what type of repayment plan you were enrolled in. Those months could be counted toward PSLF as long as you had you had qualifying employment. We're not there anymore. After July 1st, the rules went back toward what they had been prior to the Biden-Harris implementing of the more relaxed rules. Payments made while enrolled in an IDR plan or the 10-year standard plan will count toward PSLF. Other payment plans do not count. So it's really important to make sure that you're on the right repayment plan so that you continue to make progress toward the ultimate goal of getting those loans forgiven through PSLF. All right. Let's move on to the next question. Okay. After being in a holding pattern since July, my last employment certification form was updated and my counts were adjusted to reflect 120 payments on September 30th. Do I need to take active steps to get the smiley face / letter of freedom? First and foremost, congratulations to you on reaching that milestone. That is huge. We're super excited for you, and thank you so much for your public service. And now I want to show you the answer so that you can see the screen that has replaced the smiley face. So if you go to studentaid.gov, what we have seen with some borrowers is they're logging in and their balance is still listed on the dashboard. So it looks as if they still have to repay the loans. But when they go to the quick link to track their PSLF progress, they see something like this screenshot. Congratulations, you've satisfied your obligation. No additional payments are required for this loan. So our advice is go to studentaid.gov, take a look and see if this is what you see on that track your PSLF progress quick link when you look at all of your loans. And if you see this, then there's nothing that you need to do. If your qualifying payments are 120 or higher, if you'd like, you could ask your servicer for forbearance while you wait on the loans to officially be discharged. But you don't have to make any more payments. You have reached the finish line, and it's just a matter of time before the official discharge takes place. So congratulations. All right, let's move on to the next question. All right, this one is shifting gears a bit, moving toward the FAFSA. It says, I'm transferring in the spring, and I've been trying to add the new school to my FAFSA for months. Every time I get FAFSA Form Unavailable. If I don't get the school updated, they can't process my financial aid. Is it worth calling the help center to talk to someone about making the correction? Can they assist with pushing this through? All right, let's take a look at the answer. First, we recommend logging into studentaid.gov because you should be able to correct your previously submitted FAFSA. Second, Yes, the Help Center can provide help. We haven't seen any reports of issues with making corrections recently from the Department of Education, so you can reach out to the department either by phone or by using the chat feature on studentaid.gov because there might be an issue with your specific account. Just generally, we understand your skepticism. There's been a lot going on, many changes, and that has definitely impacted the FAFSA experience for people who are dealing with 24, 25 version. But just remember, the Department of Education is the source of that application because they're the source of funding for school. So if you want to go to school and you need financial assistance paying for it, then you can't get around this. This FAFSA can unlock so many sources of fundings for you. I understand you want to get it right, and you may not be confident in the system right now, but you can get help there. So just reach out. And while you're doing that, at the same time, make sure that you practice patience and persistence. Patience in recognizing that this is an unusual year for the system, and the system has a lot of people that are working very hard to keep it going and to get this to the ultimate goal, which was a simpler FAFSA experience. They're working on that. It's rough right now, but they're working on it. Persistence in that if you keep on having the same problem, don't give up on finding resolution. Just continue to ask for it, escalate where necessary, and it will be fixed. Okay. All right, let's move on to the next question. All right, this one says, I applied for SAP approval in July and got approved today. Since it is almost halfway through the fall semester, I wondered if I could still get FAFSA money or if I'd have to wait until the new semester. So first, SAP, for those of you who are not, in school or have been out for a while, SAP is Satisfactory Academic Progress. And this person filed an appeal which was approved. So their eligibility for aid is restored. Let's take a look at the answer to this to figure out what's going to happen with them for the fall 2024 semester. Even though this semester has already started and we're October, you can still get aid. So just keep that in mind. It's not too late. A summer SAP application means you were appealing for this semester to restore aid for the 2024 fall semester, that is. If you are still enrolled for school right now, you will be considered for federal financial aid for this semester, even though it's already started, even though we're almost halfway through it. Just keep in mind, the approval of your SAP appeal is a fresh one, because at the time this question came in, they said that the SAP approval came through that day. So given how fresh it is, just give your institution's financial aid office some time, and they should send you an offer that explains your federal financial aid eligibility. If you have any questions, this is a time when you definitely want to reach out to the Office of Financial Aid so that you can get, a timeline and hopefully very soon hear about that aid eligibility. All right, let's move on to the last question. All right, this one is, my institution changed my aid since I'm graduating from an undergraduate program in the fall. I plan on moving into a graduate program. Will that impact my loans for both fall 2024 and spring 2025? And do I need to do anything with my FAFSA? All right, that's a lot. Let's tackle this bit by bit. First, we're going to give you some background. Pardon my sip. Okay. So this this student had eligibility for the Pell Grant for their undergraduate experience, and for their final semester in the undergraduate program, they're enrolled in 12 credits, and they have not reached their eligibility limit for the Pell Grant or for federal student loans. Now let's start to get to the answer. All right. So when it comes to graduations that aren't in May, the institution has to prorate the financial aid package, because financial aid, if you all have ever received it, you know that it usually comes in 50-50 disbursements, half in the fall, half in the spring semester. Special terms are treated differently. But in this case, the student is graduating at the end of fall, so there would only be one disbursement. However, This student is also starting a graduate program in the spring instead of what's more often the case starting in August or September. So because of those changes, the institution is required to prorate the package based on the mid-year graduation date and the level of fall 2024 enrollment. We're listing here the formula for calculating the proration. They're going to take the number of credit hours enrolled and divide it by 24 to get that percentage that's going to be used in prorating. Then they're going to take that percentage and multiply it by the loan limit. So in this case, since the student is enrolled in 12 credits, 12 over 24 is 50%. So for the fall 2024 semester, they'd be able to receive 50% of their annual loan eligibility. Now, they're also shifting from an undergraduate program to a graduate program in the same year, and that will require some changes to the 2024-2025 FAFSA. Now they have to update that FAFSA to show that they have completed a bachelor's program, and they'll want to update their current level, which would be in a graduate or graduate professional program. And we've got here the section and questions on the FAFSA that would have to be updated. Those are listed there. I'm going to skip over that text and move to the next part of the answer. All right. Keep in mind that when you shift from an undergraduate program to a graduate school program, there are going to be some changes. The first one is that the cost of attendance is going to differ in the spring 2025 because it's a new program. It's a graduate program. The fall 2024 cost of attendance is based on the cost of the undergraduate program that this student is now finishing. Another thing that happens when a student goes from undergrad to grad is that Pell Grants are not available to grad students, so there's no eligibility there. Furthermore, there are no direct subsidized loans for graduate professional students. The government got rid of that subsidy, I think a little more than 10 or 11 years ago. So the loans that are out there will be unsubsidized. Those could be from the direct unsubsidized loans or from direct plus loans for graduate professional students. Overall, the message here is that the loans at the graduate level are more expensive because interest starts to accrue on day one, whereas those subsidized loans did not accrue interest as long as you maintained enrollment, enough enrollment while you were in school. For direct unsubsidized loans, the annual limit is $20,500 or $10,250,000 per semester. With plus loans, which we often refer to as grad plus loans, there is no limit on grad plus loans, no lifetime limit, that is. You can use graduate plus loans to cover all costs up to the total cost of attendance after other aid has been applied. So to wrap that answer up, yes, some things are going to change. Yes, you're going to need to update your FAFSA. And congratulations in advance on your graduation. And we wish you the best on the pursuit of your graduate degree. All right, now let's close out with some resources. For Marylanders, we are a state that has a Student Loan Ombudsman. You can reach out to the Student Loan Ombudsman through the state's Department of Labor and think of them as a third party to engage if you have a problem with your loan servicer or you're experiencing issues that you try to resolve with the servicer to no avail. They can help with several types of issues, such as failure by the servicer to communicate with you, errors in crediting your payments toward principal and interest, misapplied payments, inaccurate interest rate calculations, billing errors, loan consolidation or modification errors, and or inappropriate collection activity or tactics. So if you're having an issue that's long-standing and you've tried in good faith to work it out and nothing is moving, then I would encourage you to reach out to the Student Loan Ombudsman because having that weight of a third party behind you that's also affiliated with the government tends to get things moving. So check them out by visiting the state's Department of Labor online. All right. I want to thank you. I've been looking at the comments. I haven't seen any questions so far. So I want to go ahead and say thank you so much for joining us today for this edition of Office Hours. I'm taking a look at Instagram and I don't see any questions, but I do want to give a shout out to Rod_Hamilton_2 for joining us, as well as CCPS SCH Council, thank you so much for joining us for this edition of Office Hours. We appreciate you being with us. I want to thank Team McPhew for all of their support. I've been leaning on them quite a bit over the past couple of weeks as I deal with this issue with my voice. So I'm really appreciative to have the team that I have. I also want to remind you that if you have a question that comes up outside of office hours, you can always tag us on social media. We are at the MCCFW on X, formerly known as Twitter, Facebook, and Instagram. And our website is also mccfw.org. So I'm going to check the comments one more time just to see if we have any questions or anything that has come through. No, I don't see anything. So that does it for this edition of Office Hours presented by the Maryland Center for Collegiate Financial Wellness. We are going to annotate this episode and upload it to YouTube as always, so that after the event is over, you can go straight to the content that you are most concerned with. So, one final check. I know I just keep on checking because I think there are people that have questions out there. But anyway, that was the final check. We appreciate you joining us. And if you have any questions that come up, you know where to find us. Otherwise, until next time, be well.